Hey, this is Paul Hamilton. We're picking up where we left off with this middle income family of four making $40,000 in taxable wages, taking the standard deduction, no credits other than the couple that we see to the side there, the child tax credit and earned income tax credit. So a couple things before I add investments is we see their refund is just over $2,000, and that's assuming what we input that they didn't pay any federal tax during the year. So it's a pure gain, not just a return of what they already paid. Uh, so a couple things to note here. Their tax before credits was positive 1123. The child tax credit is 1,000. It'll say that. The earned income credit is 2142. Okay. So there's a couple places that investment income can come in. The first one is these two different types of dividends. Actually, I'll just do a case here. So suppose you had $1,000 of dividend income. So you have stocks or mutual funds, which are a combination of stocks, and the company pays out some part of the profits. That's the dividend to you. Now, if it was just if it's non-qualified dividends, that's where you'd stop, and you'd actually see a couple of things change here. But for most stocks, unless you're doing some kind of short-term trading, most of the time dividend income is fully qualified dividends. So you'd also, on your 1040, have $1,000 there. So going back now, we can see our refund, it went down about $300. And that's driven by not by a higher tax. The tax is still the same. It's not obvious from here, but you're in the 10% bracket. Actually, if you're in the 10 or 15% bracket for a middle income family, that's gross income of about maybe $70,000, maybe higher than that. Then you're not going to be taxed on these dividends. Okay. The one thing that makes your tax refund a little bit smaller is it is counted against you as a higher earned income. So in this case, your earned income credit went down apparently by about $300. Okay. So that was one example. I'll just leave that on there. You could also have short-term capital gain. If you do that, that actually is taxed just like income. But if you have a long-term capital gain, again, we'll just put in 1,000 there. Then we can see here everything is the same. The earned income credit again went down a little bit more because you are that counts against your earned income or adjusted gross income. So in the end, it doesn't make a huge difference, but that was fairly significant for $2,000 of extra investment income. We lost about $400 of overall tax refund. So when you start making too much money to not get the full earned income tax credit, there's pretty significant tax consequences there. For higher income households, you wouldn't be getting the earned income tax credit. So let's look at that real quick, okay? Why not? So 80,000, again, you don't have to be making $1 million bucks. 80,000, all right, obviously the amount due is going to be higher, partly because now you have much higher income. Let me just offset these real quick so you can see with and without investments. So without investments, you still get the full child tax credit. You owe $5,756. If we add, let's see here, let's go down to long-term capital gain, $1,000. Okay, and you can see that only change from 5765 to 5761. Okay, so it's actually a little bit less that you would owe. That's interesting. Um, so anyway, investments are pretty easy to enter. The one thing in terms of date entry is if you enter qualified dividends, say of whatever 3,000, the program won't enforce it, but you should have at least that much of dividend income because qualified dividends are a subset of dividend income. There's no way that it could be qualified dividends could be higher than dividend income. So, all right, that is adding investment income to estimating your 2016 tax refund.